Hello and welcome to Mayor Brown's webinar, Investing in the Trade Receivable Asset Class for Capital Markets and Alternative Investors. Trade finance supports around 80% of global trade. Restricting trade finance, or the ability to access it, is a restriction on global development. As a traditional commercial banking product, trade finance is considered a safe product, with historical default rates of less than 1%. However, regulatory capital and pricing pressures often constrain the ability of banks to provide trade finance, particularly in respect of middle markets clients, or in Asia, what we refer to as SME clients, which is a key sector for global trade. There is therefore a substantial gap between the supply of trade finance and the demand for that trade finance, with estimates of a US $1.5 trillion trade finance gap published. And whilst this gap may be increasingly being filled by specialist trade finance funds, platforms, and alternative financiers, there is a substantial opportunity in this sector. Contemporaneously, with trade tensions and changing supply chains, we are seeing a so-called trade finance pivot away to major trade hubs such as Southeast Asia, and this also presents opportunities. We therefore hope this session is timely and useful. My name is Ben Sandstad, and I am a partner of Mayor Brown's Hong Kong and Singapore offices and co-leader of our Asia Supply Chain Finance practice. Joining me today as co-presenters, firstly from Asia, Angelia Chia, a partner in our Singapore office and co-leader of our Asia Supply Chain Finance practice with me. Angie is one of the world's leading trade finance lawyers, advising on the full spectrum of trade finance products. She also has in-house experience from Cargill, JP Morgan, and most recently Standard Chartered Bank, and is an active member of the ICC Legal and BAFT committees. From London, Charles Thain is a partner in our banking and finance practice, who focuses on asset-based lending, receivables finance, supply chain and payables finance, and trade finance, and is a key member of our global supply chain finance team. From the US, Massimo Capretta is a partner in our Chicago and New York offices, and is really responsible for much of our receivables and payables work in the US. He regularly advises clients in the creation of management of bespoke receivables finance transactions, and is well known to many of you. Massimo is also a regular speaker and panelist on a number of presentations to industry participants on topics including receivables finance, asset-based lending, and cross-border finance. Before we begin, a few housekeeping announcements. Firstly, at the bottom of your screen, there are multiple application widgets. Answers to some common technical issues are located in the Help widget. Secondly, this webinar is being recorded, and following this session, we will be sending you an email with a link to the recording, which you can use to listen to the webinar again or share with your colleagues. Finally, we plan to allow time during the program for questions. To submit a question electronically, please use the Q&A widget. If we don't get to your question during this webinar, we will make every effort to follow up with you afterwards. This webinar is conducted by members of our Global Receivables and Supply Chain Finance team, which is a large global team specializing in supply chain finance, trade finance, asset-based lending, and together with our world-renowned structured finance practice, trade receivables securitization. And we advise many of the world's leading participants in the market. Many of you will know that for several years we have hosted annual live client events in New York, London, Hong Kong, and Singapore. In 2019, over 600 guests attended these programs. Unfortunately, we have had to postpone these industry summits. However, we hope to recommence these next year. In the meantime, we have put together a series of 9 webinars running until November. This is the third webinar in this series, which commenced with 2 separate sessions on the current hot topic of insolvency considerations, recordings of which are available on our website. The next webinar will be on the 19th of August and will cover the 5 most common questions about financing receivables and payables through a platform. These webinars are hosted twice on the relevant day to accommodate different time zones. On a related note, our global receivables and supply chain finance team forms part of a large industry group drawing together corporate, tax, customs, regulatory and finance teams to advise on supply chain and distribution, contracting, compliance and disputes. This is a key area for many of our clients as supply chains are cut, re-established and shored up. We are also running a series of webinars covering a range of topics such as contract risk, reshoring and reputational risk. Details are on the slide 4, but please don't hesitate to contact any of us if you would like further information. So that's the housekeeping out of the way. Let's turn to the substance of this presentation. And we'd firstly like to talk to why is it that trade finance is attractive to investors as an asset class. To start with, let's be clear about what trade finance actually is. It is one of those concepts that is used commonly, but there is actually no strict definition for what it means. It may surprise you to know that the Basel Capital Rules refer to trade finance, but do not actually stipulate what it entails. We know that trade finance is underpinned by a bona fide trade transaction where a seller sells goods or services to a buyer, but where does the finance come in and what does it actually mean? Financing in trade finance may involve financing to the buyer or the seller, including at different stages of their respective supply chains. And this finance may be by way of direct intermediation in the trade transaction itself, or it could be separate to the trade transaction. Accordingly, there is significant variety in the forms of trade finance available. Many banks have separate product parameters and product programs for well over 50 trade finance products. The main characteristics of trade finance, however, if you boil it down, are that it relates to a trade transaction in the real economy. It is typically short-term, less than 1 year. It is self-liquidating, meaning that the proceeds to repay the financing come from the transaction itself. And it is often, not always, secured or credit enhanced by goods or payment undertakings. Given the breadth of structures, we generally categorize trade finance into 3 broad buckets. Loan-based trade finance, such as import loans and export loans. Receivables-based trade finance, such as receivables purchase and payables finance. And lastly, traditional trade instruments, such as letters of credit and bank guarantees. And these differences are important to bear in mind, particularly when you're talking about the risks involved and the structuring considerations for investing in trade finance. And we will talk through many of these differences throughout this presentation. And on that note, let's welcome Angelia Chia to share what it is that makes trade finance attractive to investors as an asset class.
Thank you, Ben. In March 2017, Olivier Paul, the head of policy at the ICC Banking Commission, wrote an article entitled Trade Finance, an Attractive Asset Class. Much has happened since then, and we hope that this webinar will give you insights into the developments in this space. So, let's take a look at the size of the market that we're talking about. The World Trade Organization, in its 2019 April press release, provided the figures of US 19 trillion for merchandise trade, that is trade involving goods, and a figure of US 5.8 trillion for commercial services, which would include services like Amazon Web Services. Now, these figures do not reflect the full impact of the US-China trade tensions, and the ICC, in the 2019 ICC Trade Register report, published in 2020, surmised that the US-China trade tensions has resulted in an overall 5% reduction in trade between US and Asia. And it is anyone's guess as to what will be the full impact of the COVID-19 global pandemic on global trade. Still staying on the topic of the size of the market, why is everyone so focused on the US 1.4 to 1.6 trillion trade financing gap for the small and medium enterprises or SME sector? As reported in the Asia Pacific Trade Facilitation Report 2019, published in September 2019 by the Asian Development Bank and the United Nations Economic and Social Commission for Asia and the Pacific. The World Bank, on its position on SME finance, has found that SMEs play a major role in most economies, particularly in developing countries. Globally, SMEs represent 90% of businesses and more than 50% of employment worldwide. According to the estimates of the World Bank, 600 million jobs will be required by 2030 to absorb the growing global workforce, and hence, SME development is a high priority for many governments around the world. In summary, if the trade finance gap is not addressed, the rate of unemployment could increase drastically. This rising unemployment leads to many issues, including increased income inequality with its knock-on effects. But before we digress into a discussion on the socio-economic state of the world, the first question you would be asking is, well, what are the banks doing? S&P Global, in its article entitled Trade Finance Funds Grow as Investors Seek Recession-Proof Asset Class in November 2019, reported that banks have been withdrawing from the trade finance space due to Basel III capital reserve requirements and other new regulations. Banks are focusing on larger corporate clients and are reducing exposure to trade finance. As banks retreat, there has been a worsening of the trade finance gap. The demand for trade finance products currently exceeds the available funding, and banks can't serve all their customers as well as they would like to. Banks need to move to an originate and distribute model and are keen to bring institutional investors into the picture. HSBC and Allianz will create an investable market within trade finance by opening it to institutional investors. There's huge potential for a thriving secondary market to stimulate trade in goods and services. So, why is trade finance different from, say, equities and bonds? Trade finance assets, as Ben mentioned, are self-liquidating and can be very diverse. There could be a sale of goods in the tech, pharmaceutical, auto, or many other industries, and particularly in the tech space, trade finance can also support the sale of services. The trade flows can flow from Europe to Asia, intra-Asia, intra-Europe. In terms of market risk, while equities and bonds may go up and down, depending on whether it's a bull or bear run, people still need food, medicine, and other essentials. So depending on how the portfolio is put together, and if a fund manager is looking to even out his portfolio, trade finance assets have the ability to be counter-cyclical. For the past decade, the ICC has been collecting default data. In the recent years, the data has been usefully compiled by product, and the data comes from 25 trade finance and export finance banks covering over 32 million transactions, representing US $15 trillion in exposure. Let's take a closer look at the data. This information is extracted from the ICC Trade Register and shows you what the industry usually describes as traditional trade products, including import letters of credit, export letters of credit, and performance guarantees. We'll go into more details on such contingent assets later on in the webinar, and import-export loans. This slide depicts the data in another form, and whichever way you look at it, the default rate is low. Well, this is a supply chain finance webinar, so we do have to show you data for supply chain finance. So this is where we get to the good part. ICC only began compiling data for payables finance in 2018, and so there is only 2 years' worth of data. However, as you can see in the darker graph, the initial data indicates that the default rates for payable finance are comparable to traditional trade finance, which already is seen by the market as having a very low default rate. And just by way of comparison, this slide compares the default data of trade finance products against other asset classes tracked by banks. And as can be seen, trade finance exhibits a lower default rate than other asset classes. So how are parties investing in trade finance assets? Ben, may I hand it over to you?
Thanks, Angie. That's some really great information which we can all digest. Now, what are we seeing in the market? Firstly in Asia, then Europe, then the US. So starting with Asia, and in doing so, particularly in the context of trade finance, we'd like to compare origination first for distribution, because increasingly they're going hand in hand in Asia. So firstly, on the origination side, what are we seeing? A couple of key themes we'd like to touch on. Firstly, origination has been increasing. We've seen teams established at regional banks. We've seen teams being relocated within global banks to Asia. There's been increasing focus on origination. Secondly, Asia has actually been traditionally a traditional trade instrument-heavy region. However, the growth that we've seen has been more in the open account product space. And thirdly, particularly post-COVID-19, we've seen multilaterals increasing their support in funding real economies through funding and risk mitigation of partner banks who originate trade and supply chain finance assets in region. And this really is driving origination. Lastly, we've also seen supply chains being shored up as well. We've seen new supply chains being created, particularly with the so-called trade finance pivot. And this has led to many opportunities, particularly in the payables finance sector.
Given the restrictions many banks are facing, the advent of technology, and the increased use of open account trade with much less documentation to handle, we have certainly seen the emergence of a range of alternative trade finance providers in Asia. And we would group them into two main groups. Those using technology and platforms to deliver trade finance, sometimes financing themselves or sometimes introducing investors through their platform, and funds which have been established to either originate or acquire through the secondary market trade finance assets, which Ben will speak to shortly. And these types of players are increasingly being sought out due to their potentially greater risk appetite and ability to be more flexible on structures than banks. The most active sector are those using technology and platforms to deliver trade finance. There are different models out there. Some platforms partner with the banks who already have a customer base, and others have sought to strike out on their own. In Asia, broadly, we see that in jurisdictions where there is FX control, banks will be better able to manage the web of regulations, and it is interesting to note that just a month ago in Bangladesh, the Foreign Exchange Policy Department just issued a circular clarifying that banks are permitted to undertake certain open account transactions. In China, the net may be a little wider than banks, as the Civil Code will be amended to incorporate provisions on factoring effective 1st Jan 2021, so the market players can operate with greater certainty. We will be having a separate session in this webinar on investing through platforms.
Thanks, Angie. And you alluded to funds being established to focus on trade finance. That's absolutely right. We are seeing a range of funds with a specific investment mandate focusing on trade finance. Some cover more FI risk, others tend to take more of a corporate exposure approach. And all of them, interestingly, can try and tie into the environmental, social, and governance-driven financing that you'll see. And it may not seem immediately obvious or apparent that there are analogies between trade finance and ESG, but actually, given the developmental objectives and principles which can be achieved through trade finance and supporting supply chains and the real economy, specialized trade finance funds provide an alternative investment in this space. We also just touch on, as Angie mentioned, we're also seeing funds being used increasingly either as the SPV to facilitate off-balance sheet financing for originators, but also, interestingly, to be the primary lender for origination and then backing up the facility through their feeder funds. Singapore tends to be the hub in our region, but there's probably less than 20 funds focused on trade finance. So what does that translate to for distribution in Asia? And to be clear, when we talk about distribution, we mean the full spectrum of distributing risk, whether it be through true sale structures, derecognition structures, as well as retaining assets on balance sheet but risk mitigating those exposures. Asia traditionally has a mentality to originate on a hold-to-maturity basis, due partly to the perceived relationship consequences of distribution. However, that is certainly changing in recent years, particularly with the Basel III revisions.
Asia has about 60 jurisdictions, depending on how you divide it, with different legal systems, cultures, languages, state of legal development, and accounting standards. We generally see that Asia is the last outpost to implement newer strategies, the last frontier as it were, but with a rising middle class and with two of the most populous countries in the world, Asia is the region that has to be contended with by those looking to grow.
And so what we see for trade finance assets, if we had to generalize for distribution, firstly, in the loan bucket, the larger trade lending facilities, particularly non-FI risk, will be written in syndicated format to facilitate secondary loan trading. And that tends to drive the format for distribution. Outside of that, generally we see trade finance assets being distributed using participations. And we've traditionally followed the English law debtor-creditor style participation, but that is certainly now shifting to an equitable assignment model. In that respect, we tend to follow the BAFT template and follow BAFT because that has provisions specific to trade finance assets. We also see receivables purchase agreements as well for distributing open account risk, but these tend to be highly negotiated and very specific to the FI that originated the exposures.
With the increasing capital reserve requirements for banks, the insurance market has understood this challenge and stepped in to fill the growing need. Additionally, with regulators in the United Kingdom providing clearer guidance on the use of trade credit insurance, this has provided banks in other regions more comfort when they purchase credit insurance as a form of risk mitigation, even though it is not specifically identified as a form of permitted risk mitigation under the rules implementing the Basel Accord in most countries. Of course, it's not just a question of how the credit insurance policy is drafted, but there is an element of how the bank operationalizes the policy, and so the governance and management of residual risks do come into play.
And lastly, in the context of distribution generally in Asia, outside jurisdictions such as Australia, Japan, Korea, and probably China, the PRC, which are traditionally securitization markets, trade receivables securitizations as such do occur, but they are relatively uncommon. They tend to be private, and generally they tend to be driven by an originator looking to do multi-jurisdictional or global deals. There is, of course, an active market for removing trade finance assets from balance sheets, though this tends to be done bilaterally through participation in assignment structures. Now that's Asia distribution. Let's introduce Charles Thain in London to talk through distribution in the EU.
Thanks, Ben. So within Europe, we are seeing that there continues to be a strong distribution market for trade finance assets as between financial institutions. Obviously, each financial institution has its own reasons to distribute or participate in credit exposure, but generally it appears to be driven by either corporates wanting bigger consolidated cross-border facilities and FIs reaching their credit limit for a particular corporate or obligor, financial institutions that don't have the front office capabilities or expertise to originate but want a slice of the pie, FIs who originate but are looking for exposure to other obligors to diversify their portfolio, or financial institutions looking for a particular exposure to an obligor to increase visibility with that obligor for cross-selling purposes, and obviously FIs having to manage their capital requirements. Financial institutions are continuing to distribute core trade finance assets to other FIs using participation agreements based on BAFT templates, with the 2018 version now containing a direct assignment. For distribution of risk in receivables finance products or payables finance products, we're more commonly seeing FIs using direct assignments to achieve true sale structures for capital requirement purposes. For more committed working capital style receivables finance products, which are more akin to, say, a committed RCF product, we continue to see club deals utilizing disclosed participations or trusts built into the facility agreement or securitization structures. We are seeing that credit insurance continues to be a key tool for FIs to manage their capital requirements, with most FIs having a standardized policy with a friendly insurer. In terms of what we're seeing outside of the more vanilla distribution market, the more structured or novel products or distribution structures heavily revolve around receivables and payable products. And we'll look at some of the reasons for that later. We're seeing FIs looking at tranche funding arrangements or credit risk allocation structures for receivables finance products. This is so that they can provide a receivables finance solution to lower rated customers by distributing a more risky mezzanine tranche and retaining a lower risk senior tranche for the purpose of their capital requirements. We're seeing that both within recognized securitization structures, but also more simplified risk allocation structures that may not immediately consider to be within the ambit of the EU securitization regulations. If you are looking at these structures, we recommend that you come and speak to us. We are seeing capital markets desks within financial institutions looking to fund trade finance assets, whether originated by that FI or originated through fintech platforms or other alternative investors. And we'll discuss this some more later. We're also seeing funds entering the origination market with a view to holding their trade finance assets through to maturity, although some of those are looking to distribute also. Typically, we see the funds limited to the receivables and payables products. As I'm sure that everyone else is seeing, we're also seeing fintechs creating receivables and payables platforms for investors to participate in, typically with their selling point being the ease and speed at which they can originate, their use of AI for increased credit analysis, and a more simplified customer experience. I'll now hand over to Massimo to give you a view on the US market.
Thanks, Jez. I guess first thing I'll say is that in absence of anything else to say is that I think I would agree with pretty much everything you said with respect to the U.S. market as well. And, you know, a lot of those trends are that you identified in Europe are fundamentally the same here. I guess if I had to take issue with anything you said, it would be on the insurance side, and just to note that, you know, it's much more difficult in the U.S. To use insurance for the purposes you were describing. So that is something that is slightly different. But overall, you know, a lot of those trends are going to be the same here. And but in the interest of identifying something else or adding something to the slide, I do want to point out a few other things. One is that I think it's important to say that distribution side or the distribution of these products in the U.S. Increased pretty substantially this year. And I think a lot of that was driven sort of on the large corporate side. You know, I think everyone's familiar, at least in the U.S. market, that in March, you know, pretty much every company in the country was drawing down, you know, as much credit as possible. And I think that led a lot of banks, especially, and a lot of our clients to kind of reassess some of the hold positions that they have for some of these sort of trade products. And I think it has led to a lot more distribution from larger programs as banks are looking to kind of reduce their hold positions. A couple things to note, you know, that are kind of specific to the U.S. is that, you know, the U.S. market is much more of an open accounts receivables and payables market. But those products have been, you know, pretty vanilla and existent here for a long time. And, you know, it has, you know, over the long term, eaten away or eaten at, you know, a lot of the traditional trade products that, you know, I think most people would recognize are not necessarily growing here. And I think another thing that kind of goes along with that is that because a lot of these programs on the accounts payables and receivable side are actually growing too, and because of the history in the U.S. of, you know, having a very robust market for securitization for decades now. You know, I think it's important to note that unlike a lot of other places, a lot of the market participants in this space, you know, kind of come from more of a structured finance background. And that's going to really affect a lot of ways, the way people look at transactions, they look at facilities, and they look at risk. And it's important to remember, right? And the thing we deal with a lot here is that a lot of people coming into the supply chain finance space, they might not have spent their entire career in trade. You tend to see people coming at it from ABL and from securitization and from, a lot of other areas. And sometimes it's really challenging here to have sort of a common language or a common thinking about risk or things like that. And that's probably important to know about this market generally. And then the other thing I want to mention about distribution is kind of following on what I just said. There tends to be a lot less use here of sort of the BAF documentation, which Ben and Angie and Charles identified also on their slides as being very prominent. What we tend to find is that there's still a feeling amongst people, especially who are mostly trading open account risk, that they tend to do that trading or distribution on more bespoke sort of open account and payable documentation. So it's not uncommon here to have a wider variety of sort of underlying documentation that's going to underpin that distribution. And I don't have a slide for it, but I think it's important to note in the U.S. market, kind of following on what Ben mentioned on the origination side, we're really starting to see a real shift here. I think it's probably fair to say that outside of the traditional trade instruments, which, of course, have always existed and have always existed to facilitate actual trade, in the U.S. market, I think it's fair to say that by and large, a lot of these products, especially the sort of receivables products, up until very recently, really existed more as sort of balance sheet solutions for large corporates, right? I mean, the point of the products were to provide, balance sheet relief or to, help with, the conversion of receivables into, operating income, but they weren't really being used as working capital solutions by a lot of market participants. And I think one of the big shifts we've seen in the last year or two, both on the payable side and the receivable side, is that people are really starting to see these as proxies or replacements for some other types of working capital facilities. And you're really starting to see companies especially interested in these products as a real permanent part of the working capital base of the company, and not more of an opportunistic kind of transaction. And that's also definitely on the payable side. You're seeing, for example, very recently there's been a lot of press about the auto companies in the U.S. really pushing payables programs among their supplier base as a way to help them and support those suppliers actually, staying in business and having liquidity in these times, which, it's certainly in a lot of ways fallen by the wayside for a while in this market. So I think generally overall, big picture, distribution is definitely up in the U.S. And also, there's probably a wider group of market participants who are interested in the product, while at the same time, potentially, maybe commitments from the traditional players are also, might be going down on a name basis, kind of following along with what everybody else was saying in other regions.
So next, we thought it'd be useful to briefly consider what methods investors are using to participate in trade finance assets at the moment, and what hurdles there may be to particular types of investors. So the most obvious way for investors to invest in trade finance assets is for them to originate them directly. Origination in this space has to date been primarily limited to the sphere of financial institutions. Putting aside receivables and payables products, core trade products often rely on contingent obligations backed by the creditworthiness of the financial institution. And so originating those types of trade finance assets is off the cards for most other types of investors. However, receivables and payables products are funded products, and so much more open to origination outside of FI. And as already mentioned, we are more commonly seeing funds and fintechs originating in this space. However, those types of products do typically require back office staff and platforms which can handle large volume of granular data, and therefore not necessarily practical for most investors. Another option for investing in trade finance assets is to take a position, whether through equity or debt, in entities originating those assets, rather than necessarily investing directly in the assets themselves. But for obvious reasons, this is a very different prospect, and if investing in this way, the investor is exposing itself to more than just the credit risk arising from the assets, and will need to consider more fully the originator and solvency risk and potential tax liabilities, to name a few. Therefore, this type of investment is not really suitable for most investors, other than funds and potentially FIs working with fintechs. The third option is to directly participate in trade finance assets. With financial institutions historically being the originator of these assets, FIs have had the choice as to their investors, and for obvious reasons, it has made sense to target other FIs using simple funded or unfunded participation arrangements or direct assignments. Historically, participations were more common because often the FI may have had restrictions in its underlying documents from transferring the assets, and also unfunded participations lend themselves well to contingent liability trade instruments. But FIs are continuing to ensure that their documentation permits various distribution channels, with direct assignments now being more common for receivables and payables products, at least in the European and Asian markets. With limits to other FIs being reached, financial institutions are still using participations in direct assignments, but now looking to couple them with funding structures using either funds or capital markets. Further, with fintechs and funds now more commonly originating receivables and payables products, they're also looking at these methods and funding structures to bring in investors. But with any funding method underpinned by participations or direct assignments, the investor needs to carefully consider the risks, such as legal and transactional risks, i.e., what is the governing law of the asset? Can it be transferred? And has it been correctly transferred? Tax risks, such as withholding, i.e., will I receive what I'm expecting to receive? And obviously insolvency and commingling risk in respect to the originator, i.e., what happens if the originator is holding my proceeds when it becomes insolvent. Massimo is now going to discuss the use of capital markets a bit more.
Thanks, Charles. So I'm going to take just a minute to talk about, I guess, what Charles referred to as capital markets solutions on this slide, and then we have some additional coverage later on in the deck. This is the positive slide, so I'll do this one first because there is, a lot of interest amongst, our client base and the market generally in, broadly sort of non-traditional, sort of more capital market-focused distribution solutions. And, there's a reason why that would be the case, right? I mean, it's relatively obvious, but we went ahead and prepared a slide anyway. One is, there's a very large untapped investor base, a large percentage of, the market that has actual money to deploy does not participate in trade assets. And primarily because vehicles that are available to distribute those assets don't necessarily match up with what they're looking for. Obviously, one of those things is that for all of the reasons that Charles described on the previous slide, a lot of these ways to participate or to have access to these products are not passive, right, which is what people are looking for. The other attractiveness of it is that, there's a huge demand, as Ben pointed out at the beginning of this presentation, for people to find safe assets with attractive yields, right, that are offering better return than bonds or unsecured bank exposure, which today is very little or no yield, or maybe even potentially negative yield. Three, the great thing about these types of solutions is that, in theory, is that once they're set up, there's very little that needs to be done, and investors could move in and out, unlike, most current existing methods, which require, active, I don't want to say management, but definitely active involvement. And in theory, at least, some of these solutions could, avoid or lessen regulatory, and reporting requirements that exist with securitization, at least outside the U.S., and also could, in theory, help with counterparty risk, which, as Charles was pointing out, and which will appear in some of the later slides, under the current methods used in this market, a lot of the pooling and aggregating structures that exist do have counterparty risk, and it's very difficult to eliminate that using current methods. While it certainly can be mitigated, and we'll talk about some of that a little bit later. But that's kind of the positive slide on capital markets, and we'll have a little bit more on that a little bit later in the deck.
Thanks, Massimo. So, ladies and gentlemen, let's now turn to the next section of this presentation, and this is where we really draw together all of our expertise to link the uniqueness and the idiosyncrasies of trade finance, and to suggest some structuring considerations for you if you're looking to invest in these assets through the capital markets. So firstly, on this slide, we've listed out some of the typical considerations that may apply. And we're going to talk through some of these concepts for you now. And firstly, starting with understanding the investment. And this may sound ridiculous, particularly coming from a bunch of lawyers to professional investors. But you would no doubt agree that usually the devil is always in the detail. And given the diversity in the trade finance universe, that is perhaps truer here than it is for many other product categories. Now, we'll talk in a couple of slides' time through some of the differences in risk profile for products, trade finance products, which are actually very similar, or they sound very similar. At the moment, we'd like to touch on receivables. And let's think about the nature of receivables. We know that there's inherent diversity. They differ seller to seller, jurisdiction to jurisdiction, industry to industry, but they're generally short-term. And if you just focus on that short-term component, if you're structuring a capital markets investment, obviously you'll need to allow some kind of revolving period for continued sales of receivables to provide sufficient tenor for your capital markets investor. Sounds easy? Yep, sure. What about, let's assume that everything goes well, the seller performs, and you get to the end of your revolving period. Do you then let the structure amortize rapidly? In other words, you just let all the receivables pay down, and given that they're short-term receivables, you could amortize a couple of $100 million structure within a month or two. Or do you have more of a controlled amortization tail? What about if during the term something goes wrong with the quality of receivables that are being originated? You'll need some kind of early amortization triggers to not only stop receivables purchases, but to trigger unwind of the structure and amortization of your capital markets position. What should these triggers be? Of course, you factor in default rates, dilution rates, perhaps also average payment terms, and parameters around the time it takes for the pool to revolve. Perhaps also you might want to contemplate limits around excess cash to minimize or limit negative carry. Massimo, what do you see in the space in the US?
No, I think Ben, literally everything you said is I would certainly agree with. I think a lot of times one of the biggest problems is getting a handle on the underlying asset because unlike other types of structured finance, for example, that tend to be very, very asset specific and very, they're sort of existing rubrics for what the asset would look like, especially things that are based on consumer type assets. I think the thing with receivables is that there's such a wide variety of what exists in the marketplace, structures, products, that sometimes the underlying understanding the asset and diligence part of the exercise can be, daunting, right? And we struggle a lot with those kind of issues here, for sure. But pretty much everything you said, I think, is spot on.
Right. I'm glad to hear that. So if that's the case, what about obtaining a focused investment? And we're really talking about your typical considerations of isolating the assets and ensuring that you've got asset isolation by some form of transfer from the originator, and then the holding of such assets in some form of appropriate insolvency remote entity. Now, these aspects are not really trade receivables specific. They apply to most structured finance transactions, so they should be relatively familiar to you. But basically, we need to ensure that there is a true sale or otherwise suitable transfer of the ownership interest in the assets. Accountants tend to focus on derecognition accounting treatment and corresponding recognition in the books of the SPV. Lawyers, we of course focus on legal true sale, which for the record is not a legal term of art, but it really means, have we got some kind of assignment or transfer or other means of isolation of the assets sufficient to ensure that ownership interest will not form part of the insolvency estate of the originator. From an accounting perspective, as mentioned, the key thing is to get the recognition treatment. Broadly, this aspect is achievable in most jurisdictions. There is, of course, a link to perfection. In other words, if you're effecting a transfer of assets, what do you need to do to perfect that transfer against all relevant parties to ensure your ownership interest is effective against those other parties? For trade receivables, given the volume that they are originated in, if you want to give notice, for example, what's the most effective way to do that? Often, of course, we'll rely on an amendment to the invoices that are generated to refer to an assignment structure. But it need not always be done like that. But Massimo, surely you've got more flexibility on true sale with your true participations and certainly on perfection with your UCC filings.
You love to say that because you want to point out that it's easier to do this stuff in Asia than it is in the U.S., don't you? I can see that. So I'm going to humor you, Ben, and I'm going to say that one of the benefits of the U.S. system, of course, is that we have the Uniform Commercial Code, which creates a very well-structured regime for actually acquiring open account assets and maintaining perfection and obtaining perfection and priority and that kind of stuff, which actually works very well. And the downside of that is, of course, there is an existing regime and there is an existing structure. So a lot of times that structure and regime does not necessarily work alongside what exists outside the U.S. So it's a very common response here because when we spend a lot of time looking at non-U.S. structures, I think it makes people sometimes unhappy that because we have this existing system here, even if you've structured your transaction and all of the parties have agreed that the transaction is going to be controlled by some other law, England or Singapore or whatever, if there's a U.S. connection, you're going to invariably have to deal with that system. So there are positives and negatives for sure. Positive that our system actually provides certainty. The negative is that it is certain that you will deal with our system if you have a U.S. connection. And the one item I think I do want to very, very quickly point out is that especially around the bankruptcy remoteness, it's sometimes I would really urge people to pay a lot of attention to that issue because a lot of the products and a lot of the structures that exist in this sector, at least in the U.S. market, they tend to use securitization terminology, but a lot of times the underlying assets are going to perform differently and the underlying risks are going to be different. And it is really important to think about those kind of issues before you spend a lot of time going down some structure. You want to deal with very basic things like Ben is talking about at the beginning, right long before you get to any kind of term sheet or offering kind of teaser type thing. But Ben, generally speaking, is that satisfactory? I have both confirmed what you said and also agreed that Hong Kong is better.
Perfectly satisfactory, Massimo. Thank you so much.
No problem.
It's an interesting point that you mentioned bankruptcy remoteness or insolvency remoteness, which is another non-legal term of art. And just thinking about that, we're talking about the standard things, restricting what the SPV can do, and generally structuring the SPV to minimize the risk of insolvency, whether voluntary or involuntary insolvency. Or, of course, also ensuring separateness or limiting the possibility that there'd be any substantive consolidation or otherwise piercing the corporate veil. And what strikes me is even if you get to the point that you've got a great asset transfer and you've set up your SPV or your vehicle so that it is, as far as possible, bankruptcy remote, you don't want to fall in the trap then of having to consolidate that SPV back onto your balance sheet and effectively not achieve the benefits of off-balance sheet financing for the originator. And in Asia, we tend to follow IFRS. And so when we talk about consolidation, we really talk about, is there power, or in other words, existing rights to affect the ability or direct the activities of the SPV? And is there an exposure to variable returns or the ability to affect variable returns? And really that really relates to the ability to use power to affect returns. And if you've got those, then actually, even if you've done everything right, you may have to consolidate the SPV back onto the originator's balance sheet. And Massimo, I believe that's actually more of an issue in the US, under US applicable rules.
Yeah, I mean, I think it's interesting because in a lot of the products that we do, as you know, Ben, we always tell clients that, you know, IFRS and GAAP are aligned, but not in this area, right? I mean, I think there still remains, you know, a pretty big difference between US GAAP and IFRS on some of these issues. Like, for example, I mean, just on the positive side, you know, in the securitization space, it's still common in the U.S. that, you know, SPVs are owned by the originating entity and they have a big equity position in them. So in one sense, it's easier. In another sense, it's harder, right? Because you know, it's constantly evolving. There's definitely a big yin and a yang in this market, or definitely a positive or alpha and omega or whatever you want to call it, between and tension between, you know, the accounting treatment and kind of how the market adapts when new accounting rules come out. So, for example, this year, at least in the securitization space, we're really just now getting to a point, the last 18 months or so, where we're adapting to some new accounting guidance that came out, and many transactions that were off balance sheet became on balance sheet and now are slowly being restructured to sort of satisfy those new requirements. So I think the one thing that is for sure is that in the U.S. market, I think it's more dynamic and there's actually more change going on, and the market reacting to that change, at least the last few years, than I think you see outside the U.S.
Sure. And I guess just to finish this slide very quickly, of course, there are your standard servicing type issues. Focusing on servicing when you have trade underlying, particularly given the short-term nature of receivables, if you do have perfection requirements, how do you involve those perfection requirements in a meaningful basis? If you have a contingent perfection regime, for example, is it going to be meaningful in the context of short-term receivables? Standard things, do you need a backup servicer, etc.? And considerations such as, will the originator be able to continue to generate sufficient eligible receivables of sufficient quality? Who is responsible for amending credit terms? And what restrictions do you need to have in place in that context? So how about enhancing the investment? And we're really talking about credit enhancement here in this context. One of the interesting things about trade receivables is they not only involve risk of default by the obligor, default risk, they also include a range of non-credit risk-related matters that may prevent payment. The risk of commercial dispute, for example, the goods do not match specifications. The risk of dilutions, for example, reductions in the amount payable due to product returns or wrong invoices or discounts being offered, and particularly in the context of international trade, political and country risk. So what that translates to as a structuring consideration is that the default risk and the dilutions risk and the dispute risk is constantly changing throughout the life of your transaction because you are substituting in new receivables. So that therefore means that your credit enhancement to address these risks also must be dynamic, and so you'll need some form of dynamic calculation, and we typically see a look-back calculation and subsequent adjustment to credit support throughout the life of the transaction. Rating agencies, of course, look at these issues. They also look at what credit enhancements there is. We typically see over-collateralization, reserve accounts, particularly for senior expenses and interest. There is a cash flow. We'll also typically see reserve accounts for dilution risk. In Asia, not so much in the US, as Massimo alluded to, we also see trade credit insurance used quite frequently, which will allow PD substitution in respect of the buyer credit risk, the default risk. And when you're looking at using credit insurance in a capital market structure, of course, there are various considerations to address: the transfer of the insurable interest in the assets to the SPV, who is providing the requisite information and is subject to obligations under insurance law, such as the duty to disclose, and how do you mitigate or minimize the risk of inadvertent voiding of the insurance policy. We will talk through all these issues actually in a subsequent webinar in the series covering trade credit insurance. Rating agencies also, of course, cover structural considerations. What are the eligibility criteria? Who determines those? Who audits those? Do they cover performance risk? Do you exclude intra-group receivables, for example? Is the portfolio of receivables sufficiently diversified? Do you have large exposures, concentration risks, etc.? They will, of course, also look at the legal structure and review the legal opinions. Massimo, am I correct in recalling what you mentioned about trade credit insurance not being a typical credit enhancement in the US?
Well, that is sort of true, Ben. I mean, I think it's fair to, I think it's, what is not true is that, insurance is widely used in the U.S. market. I mean, both on a transaction-by-transaction basis as well as a program-wide basis. A number of our clients have program-wide credit insurance policies in place that they utilize all the time. I think what's not as true is if you are a U.S. bank, is that you're getting a PD substitution for that, because that's actually much more difficult in this market. So products definitely exist and are used all the time, but then the use of the product might be a little different. And that the one thing I will mention, and we do hope you tune in to our program on insurance that Ben mentioned. What is also true about the U.S. market is I think there's not nearly as much sort of basic knowledge about how those insurance products work, mostly because I think the U.S. has been kind of late to the game in the insurance business, or the credit insurance market. And, there's still a lot of usage of the products, and there are a lot of products being sold that the buyer isn't necessarily fully understanding the risks, rewards, what the policies actually say and what they cover. But please tune in to our follow-up program, and we'll try to address some of those things more fully. So having said that, I think I'm going to just switch to the next slide and very quickly just cover some of this capital market stuff, because I said there would be bad news later on, and some of these items have already been covered by Ben, so we don't have to, and Angie and Charles, we don't really need to rehash them again, but I will just mention very quickly that some of the main challenges that we have when we deal with these types of products are, fundamentally the biggest issue is that these are revolving structures, right? So if you're a traditional ABS investor, sometimes it's hard to create a structure that works for you. Two, I think one of the bigger issues that we didn't really spend any time on is currency issues. Because, of course, most investors want to fund in a single currency, but the underlying assets are generated and oftentimes originated in multiple currencies, right? So there's sort of this inherent currency risk, which we don't need to really focus on right now because I can tell by the clock we're running out of time, but it is something to consider. And then I think, at least in the U.S. market, at least what I find is one of the biggest challenges to deploying a solution like this, or sort of a broader capital markets type solution, is that many times when you look at a potential problem that could be solved by that solution, at least historically in the past, there's been another way to do it that's been faster, cheaper, simpler, not necessarily better, right? I mean, it might oftentimes solve a short-term problem, but might, maybe in retrospect later on, or sort of big picture, it would have been better to maybe try to address something bigger picture. But sometimes it's hard to think about the long term when the short term solution is kind of staring you right in front of you. And then finally, the one thing I will mention is that, of course, these are trade receivables, and there is an active market for commercial paper out there, at least in the securitization space. So, when you're looking at different products, sometimes that product is easily tradable. So, and depending on who you are, that might solve whatever need you happen to have at that particular day. So I think sometimes, and you're starting to see that now, people are really thinking about these solutions more than in the past, because I think they're starting to recognize that they can provide, a big picture kind of long-term strategy that isn't going to be available or isn't going to be addressed by a short-term one-off transaction solution. And I think that's all I really want to say on that slide, because I really do want us to get through the rest of the deck.
As Ben mentioned earlier, when investing in trade finance assets, it's important to understand where the credit risk and other risks sit within those products. We were originally intending to dive into a couple of the various different assets and discuss where the credit risks and other risks sit within those products, but we're a bit short of time. So the next couple of slides have some detail on that, and you can look at that in your own time. So I'll now hand over to Angie for some closing thoughts.
Thanks, Jazz. In the interest of time, I'm going to rush through the following slides just to re-emphasize that we are dealing with different types of products with different risk parties, and the risk parties can change over the course of the life cycle of the product. One thing that was noted in an S&P Global article was that there is a need for education of investors. In a survey of 56 key decision makers at European institutional investors, it found that only 1 in 10 had a solid understanding of how secured and unsecured trade finance investing works. So we're going to take a close look at the issue. So these are some of the questions that the investors asked, and the industry has tried to answer some of those questions. As my grandmother would say, this is like getting the ducks and the chickens to understand each other. Broadly, the industry bodies have come together to try and explain the trade finance products, and one good piece of work was the standard definitions for techniques of supply chain finance and the supplemental guidance on specific products. Now, this is very much focused on the open account space and not the traditional trade product space. And of course, the question that all investors would always ask is default rates. So with default rates so low within the trade finance space, a bank on its own would not have enough data points to come up with effective data. And so the ICC has pulled the banks together to pull the ICC trade register, and that does give meaningful data to most investors and regulators in the space. Now, does the investor market have the resources to finance trade finance, and more particularly, have the resources to help fund the trade finance gap? According to the PwC report, it surely does. It is a question of bridging the gap and helping investors understand the nature and value of trade finance as an asset class, not just from an economic perspective, but the important social impact of such investments. It is not often when a lawyer can participate in a global effort that makes a meaningful change in the world. Thank you for sharing this journey with us, and we hope that we have done our part in serving a higher purpose just beyond putting terms and conditions on a piece of paper.
Thanks very much, Angie, for those inspiring words. Ladies and gentlemen, apologies, we've gone over time. There is so much to talk about in this space. Given that we've run over time, unfortunately, we haven't been able to get to questions, but if you have submitted questions, or if you'd like to, please do, and we will definitely respond to each of you and each of your questions that we've received. On behalf of Mayor Brown and my colleagues, thank you so much for joining us and giving up your time to listen to us. We hope you found this webinar useful and that you can join us for our future programs. A recording for the seminar, as well as a link to the full slide deck, will be distributed to you by email shortly, so please watch your inbox for that. Thank you once again for participating, and ladies and gentlemen, please stay safe. Thank you.